Commissioner, 7th District, also the chair of the Cook County Commission on Social Innovation. We're going to get started today with our presentation. This is our first nonprofit capacity building workshop that we're doing in some of the suburban areas. So we're excited to be here in Franklin Park. So I thank the Village of Franklin Park and of course Mayor Peterson for allowing us to use this space. I also want to just acknowledge that our Vice Chair, Marc is here today. He's been instrumental in helping us in partnering up with Social Enterprise Chicago in helping us today with the workshop. So we'll get started with introductions and we'll have Valerie, Leonard actually help us out with the first part of the presentation, and then we'll go into Vice Chair Marc Lane's presentation. So thank you.
Great. Thank you so much for having me. My name is Valerie Leonard. I am the founder of nonprofit Utopia, and if you don't mind, I'll just take you through a few slides to talk about capacity building. I realize that there are a number of different areas you could have asked me to speak about, but I felt it was really important for people to understand how important it is to do organizational capacity assessment. So often we want to save the world, we want to do the work, and all of us are doing the work, but sometimes it takes a whole lot more to just step away and really assess how well we're doing the work and make sure we have the systems in place so that we can do our work with more impact. And then on top of that, sometimes when we do our organizational capacity assessments, we're so focused sometimes in doing what, quote unquote, the funder wants us to do, and we're just kind of checking off boxes and all of that good stuff, but we're not really taking advantage of the real opportunities to create value for ourselves, for our funders, as well as for our clients. So we're here today to talk about creating value through organizational capacity assessments. A little bit about myself. I am the founder of nonprofit Utopia, as has been said at least twice within the past 5 minutes. And what we do is we focus on building the next generation of ethical nonprofit leaders. And for myself, you know, not only do I work with nonprofit Utopia helping to build capacity, but we do a number of podcasts as well as live streams. I do coaching, and from time to time, I serve as an adjunct instructor at University of Illinois in Chicago in their certificate in nonprofit management program, as well as for Roosevelt University at the Heller College of Business, helping out with their social enterprise program. And I am here as a guest of Marc Lane. Marc is the president of Social Enterprise Chicago. I'm a member of the board. He so graciously invited me to present, and I am grateful for that. When we look at where the information comes from, it comes from the Point the Way Chicago Area Capacity Building Landscape Study. There was a report that was done in 2017. We wanted to look at how people and organizations were building their own capacity to serve clients. And then an article that I wrote, What is Capacity Building and Why You Should Care, and all of that, right? So again, nonprofit Utopia, we build the capacity of organizations. Our mission is to train the next generation of ethical nonprofits, and the way we do that is through coaching, we do it through consulting, we do it through courses and e-commerce. And our learning objectives for today, for lack of a better word, we're going to share with you what we mean by value. So we're going to establish a common definition for the word value as we're using it. We're going to also help you understand what it means for small nonprofits to build capacity, because we know building capacity means different things to different people. and then we'll share some of the resources and tools that you can use, and then share with you also some steps that you can take. Do this at home, please, and improve your organizations. So the first thing we want to talk about is what we actually mean when we say create value. Because again, those terms can mean different things. This is when we talk about creating value, we're looking at the intersection of what our customers need. And yes, even if we are nonprofits, we do have customers, right? We're looking at the intersection between what they need and the products and services that we provide. And one thing we have to remember is we can provide goods and services that are necessary, but if nobody is willing to spend money for them, if nobody is willing to spend time to get what we have to offer, then we're not creating value. All right, and some of you may be familiar with this value proposition canvas. This was done by Strategizer, and you'll see this a lot in social enterprise, especially on the for-profit side. I think it's important for nonprofits to get familiar with this canvas. And basically what you're doing is you're looking on the right side of the canvas first. You are really trying to get a better understanding of your customer. So ideally you would do this for every customer segment. You know, if you're for-profit, you're going to segment your customer base and you'll go through this exercise. If you are a nonprofit, typically your segments are going to include the clients that you serve. It will also include your funders and partners and all of those people. But the key is to really understand who they are, what their daily lives are like, what makes them tick, right? What are they aspiring to? What are their gains? What are their pains, right? And then you want to provide products, services, right, to address those pains that they're having and create a better quality of life. So you're going to have products and services that will be gain creators, pain relievers, and then make people's lives easier. So in order to deliver the maximum value to our customer base, we oftentimes need to go and build our own internal capacity. So when we talk about capacity building and why it's important, we look at the definition, and it's basically any intentional and sustained effort to improve an organization's function. So for our purposes, you know, it is those activities that will strengthen our abilities to better serve our clients and our communities. And when we speak about a focused intervention, we're really speaking of focusing on one component. You know, for example, you know, you might be part of an organization that wants to do board development because you see that there's some key issues holding the organization back, and you think that you need to start with the board, which is always a good place to start, by the way. So a focused intervention, you're only focusing on that one thing. You know, some people focus on financial management or whatever. Most commonly is the developmental intervention. That's when you're looking at several pieces of your organization and looking at the capacity along very specific parts. And when we look at a typical model, this model was put together by the Point the Way study. Actually, it was the Capacity Builders Funding Group that commissioned the Point the Way model. And they looked at capacity along 7 different areas. The first was looking at the vision and impact model, making sure that as organizations create their vision, they're also putting the systems in place to actually fulfill that various vision. Then you look at governance and leadership. When we talk about governance and leadership, we're talking about our boards and all the systems to actually make decisions
decisions and guide our organization strategically. We're also looking at program delivery as another one of those components, and I think we're pretty familiar with developing programming and making sure that you have the skills and the facilities and other resources to do that. Then we talk about resource generation, which is a nice way to talk about fundraising. And then we have internal operations and management. And just think of internal operations and management as all of those supporting activities for your program. So anything that is not a program, typically it's going to be operations. And then evaluation and learning. What systems do you have in place in order to capture the impact that you're making and to be able to communicate that impact? And then strategic relationships. How do you work with outside partners to actually improve your programs, improve your impact, and improve your reach? So who really cares about capacity? Ideally, the people who have a stake in your success, all of them care about your capacity. So that would be your board members, your staff, community, potential funders, as well as potential partners, current funders, and current partners. So when you look at this list, and I promise I won't read everything and describe everything, but you can see there are a number of capacity building activities in which you should be engaging. We should always start with community needs assessment because we want to make sure that whatever services, whatever products we provide are relevant to our changing communities. It's also important for us to develop a theory of change because we want to really understand what's going on in the community, what are some of the issues that are facing our community or that our people are facing, and then figure out how are we going to actually change the conditions for the better. And again, there's a whole list of activities that I won't read aloud. I will make sure you get a copy of this presentation so people can see for themselves. All right, so how do we actually assess capacity? So when we talk about capacity assessment, we're not necessarily talking about doing a formal evaluation, although you need to have an assessment in order to do the evaluation, but you need to have some objective way of taking a snapshot of where the organization is today. So we all assess organizations, and usually that's through first impressions. First impressions of the people we meet from the organizations, just watching the way things happen all around us and around the people in the organization. Another way we can assess organizations is through the assessments, surveys, and I'll share an example. We can also do a SWOT analysis, which is looking at your strengths, weaknesses within the context of what's going on in the community or just externally, the opportunities and threats. And then we can look at interviews, observations, and focus groups. So for our purposes, I'm going to just share this as an example. Nonprofit Utopia has an assessment tool where we have basically aligned the tool with the 7 different indicators that are found in the Point the Way study. And the reason why we did that is the Point the Way study was commissioned by some of the top funders in the Chicago metro area, and it will behoove all of us to understand the thinking that they have as they approach assessing our capacity, right? So we have the ability with this tool to help organizations assess their capacity in 7 different areas. And then on top of that, we have the ability to help them understand whether or not they're ready to qualify for GATA. And GATA is, I can't remember the exact name of, well, the exact names that go to the acronym, but it's basically a state of Illinois kind of thing. There is a law that indicates that any organization who is seeking funding, they have to be pre-qualified. And, you know, that's not the only part of the law, but that's the part that we care about. And we're interested in making sure that people know whether or not they have the capacity to comply with that before they even apply. All right, and then you have the sample SWOT analysis here. The way we structured it is a worksheet where you can look at, again, your internal strengths, look at ways you're going to capitalize on those strengths. You also look at your internal weaknesses and look at ways that you can reduce the risk of being snared by some of your weaknesses, and also look at ways that you can improve. Right? And then when we look at those external factors that you have no control over, you know, such as the opportunity, so we want to look at what's going on externally that we have no control over that can actually help us build momentum, right? And then also externally, we want to look at the threats and see what it is in the environment that can actually keep us from meeting our goals and our objectives. And here is basically a flow chart of our process. Ideally, you would go through the organizational assessment, right? And you'll give that a score, or those different categories a score, your rank, whatever your issues are. And then you will do the same thing for the SWOT analysis. You'll take the information from that organizational capacity assessment, and then, you know, use some of those answers to do your SWOT, especially the strengths and the weaknesses, you know, the opportunities and threats. That data would probably come from another source. And once you do that, you want to prioritize your issues and then determine, you know, where you want to start, what happens first, second, third, and all that good stuff. And then you want to develop goals and objectives. And when we talk about goals and objectives, we're talking about goals and objectives for your internal capacity building process. And then we need to look at the resources that are going to be required to move us from where we are to where we want to be in terms of our capabilities. And then after that, we're going to outline the activities in which we engage. So that could be things like strategic planning. It could be things like actually automating our financial systems. You know, anything that we find that we can improve on in terms of a process, in terms of a program, those are the things that we want to identify. And then if you're like a typical organization, you'll probably find 50 things that are wrong, right? But you need to focus on, say, 5 to 7 things that you're going to achieve within that small period of time for you to do your capacity building. Then you want to identify the outcomes. And when we say identify the outcomes for your capacity building, what is it that you want to do differently or do better as a direct result of being involved in this capacity building? And then you want to actually outline the measurements. You know, so what metrics are you going to use to show that you're actually turning the corner? You want to identify the data that you're going to collect from time to time to prove that you're actually making movement. And then when you do your plan of action, you want to make sure that you have a list of tasks, indicate who's going to be responsible for doing them, and then give a deadline. And then after that, you develop a budget, and then you develop a system for monitoring your progress, and then you report out periodically. All right, so you're asking probably, so how does all of this translate into greater value? And I find that this is where many, if not most, organizations fall short. They go through all of what I described, but they haven't been able to actually convert that into value. So, you know, many of them are saying, well, I'm too busy doing the work, so to speak, so I can't really participate in those activities. Or if they do, they're doing it half-heartedly just because someone told them to do, and it's usually a funder, right? But there's a study from the American University and North Carolina State University, they found that organizations that received any type of capacity grant, so it didn't necessarily have to be a grant writer, any outside help with capacity building, it translated into a 10% growth just from doing the capacity building. So that's a pretty compelling reason, I think, to engage in this process. So that's value in that perspective, in that regard rather. You also have additional benefits, including the ability to serve more people more effectively, make a greater impact, and you'll be able to demonstrate it. You'll actually have more efficient operations and long-term sustainability, and all of that stuff translates into more money, more money, more money. And as I told you before, you haven't created value unless you have figured some way to attract money. And you're at for your clients, value for your partners in that kind of way as well. So I'm going to close this off by sharing with you, these are 6 capacity building resources. You've got AMPT, and they work with Black and Brown communities, capacity building on the south and west side of Chicago. You've got nonprofit Utopia, you've got Forefront, you've got nonprofit courses, Catch a Fire, the Association of Consultants to Nonprofits as well. And I would be remiss if I didn't put a plug in for Social Enterprise Chicago, and Marc is going to tell you much more about what we do, but we are definitely a resource that you can come to as well. All right? So here's my contact information. That's my story. I'm sticking to it. I hope I didn't take too much of your time. And if there, I don't know if there's time for questions, or if I should just, move out of Marc's way and let Marc present.
I think there's a question.
Okay, yes, ma'am.
I'm sorry if you already mentioned it, but that last slide with the companies that help the community, is there a fee for that, or do they provide additional services?
Yeah, all of that is free except for my services. Everything except nonprofit Utopia is free, but I do, as a matter of course, have a lot of resources that I can share, but everything else is free. All right?
Thank you, Valerie. Let me find my slides here. Okay, good afternoon, everybody. Pleasure to be with you this afternoon. I'm Marc. I'm an attorney and financial advisor to nonprofits, social enterprises, and all the other stakeholders in the evolving social impact ecosystem. And today I'd like to talk to you about the development of earned revenue by a nonprofit organization, how that's accomplished, and why it's accomplished. And I'm going to do it through the lens of a specialized business form that nonprofits are increasingly created as subsidiaries to hold their business interests or strategic alliance partners with nonprofits. And as you may expect, when a nonprofit seeks to become more self-reliant, self-sufficient by creating earned revenue, is becoming a better steward of the resources entrusted to it. It is less dependent on government contracts, government grants, and philanthropy. It can call its own shots, make its own decisions. And when it does so, and we walk them through a process where we look at their core competencies and underutilized assets, business might make the most sense for them. Upon the conclusion of that process and ultimately the launch of a business, we will almost inevitably suggest that the business be held by the nonprofits in a newly created entity, so that for asset protection purposes, any legal liabilities that might be created at the business level does not bounce back and adversely impact the pre-existing nonprofit's parent or strategic alliance partner. I'm going to talk with you about a specific form of business entity that is used by nonprofits to hold their business interests and run their businesses. It's called the O3C, the Low Profit Limited Liability Company. We're going to talk about that. And by looking at the O3C, we're going to be talking about opportunities to access capital for nonprofit-owned businesses. And we're also going to look at some governance issues that affect nonprofits that seek to operate entrepreneurially through the creation of earned revenue through a business that they launch and operate. So while I still have your attention, I want to talk to you a little bit about tax law. And better yet, I want to talk to you about ancient tax law. How many here know about private foundations? Virtually everybody. Okay. So then you know that private foundations enjoy specific tax benefits. Donors who give money or securities or other assets to a private foundation generally are permitted to deduct the value of those assets on their individual or corporate tax return, and the earnings that a foundation realizes are generally going to be exempt from federal and state income tax. The reason for those tax benefits being afforded to foundations in the first instance is because Congress anticipated that foundations, being true to their missions, will make regular, significant distributions of cash to nonprofits or other mission-driven ventures. And from a public policy perspective, affording those foundations tax benefits really encourages the deployment of resources for social purposes. That didn't happen automatically, however. And up until 1969, foundations had no specific obligation to distribute any specific amount at any specific time. And some distributed assets readily and frequently in large amounts. Others would hoard assets. So Congress intervened, and as part of the Tax Reform Act of 1969, for the first time, Congress imposed upon private foundations the duty to distribute 5% of their assets annually for charitable purposes. 5% intended to be a rough justice calculation of the earnings on the foundation's corpus or portfolio. Congress thinking, well, let's let them keep the principal, but as they make money, have them kick out the money for charitable purposes as the trade-off for the tax benefits they enjoy. Ever since, there has been a feverish competition among charities seeking grants from foundations. And that's the genesis of that opportunity for funding among nonprofit organizations, but as you'll find also, even for for-profit subsidiaries of nonprofits or freestanding social purpose businesses. And we're going to talk about that because the L3C is used in all of those contexts throughout the United States. And there are now something like 2,500 operating L3Cs around the United States. I happen to have written a law on this subject, so I know a little bit about it, and I'm happy to share that with you. So the first thing you need to understand is that grants are not the only way in which foundations can meet their 5% distribution requirement. there is a specialized form of investment that a foundation can make that qualifies as a distribution. Now, one would not ordinarily think of an investment as a distribution. A grant, yes, you're writing a check, it's an expense, the money's not coming back to the foundation. But an investment is going to continue to be carried on the balance sheet of the foundation. If it's a debt investment, interest will be paid as agreed, and the loan will be paid off at maturity. If it's an equity investment, there will be eventually a liquidity event where the foundation gets its money back, hopefully with appreciation. Nevertheless, for IRS purposes, both grants and program-related investments, this specialized form of qualifying investment that counts as same as a grant would, is available to foundations to meet their tax-driven requirements. So the foundation is obliged to distribute either 5% of its assets annually as grants or as program-related investments, or some combination of the two, so long as in the aggregate it's at least 5% of assets. Now, program-related investments are a very peculiar animal. Foundations are typically prohibited from investing speculatively. Why? Because they're using tax-subsidized money. Remember, the donor who gave that money to the foundation wrote it off on his or his tax return. And similarly, the foundation's earnings are going to be tax exempt. So foundations and foundation managers are prohibited from making high-risk investments lest they jeopardize the mission of the foundation. They would be squandering that opportunity to grow wealth and ensure that over time it's distributed for appropriate charitable purposes. Yet, the program-related investment is exactly that, and it's sanctioned by statute. It is a high-risk venture capital type of investment, which not only does not subject the foundation or its management to an excise tax, which would ordinarily be the case if the foundation invested in high-risk investments, but indeed the law favors and encourages program-related investments by foundations into charities or for charitable purposes. And we'll explain why that is now. And the reason is that the investment is primarily intended to drive a social or environmental agenda. These are all purposes that are permitted for nonprofit tax-exempt organizations to be set up. And it's a familiar litany of charitable and similar purposes. Well, the program-related investment, or PRI, must be intended principally to drive one of those kinds of causes. Whether it's in a nonprofit or a for-profit is incidental. The program-related investment also is not to be made principally to generate significant income or to grow assets. Now, there's nothing retrospectively or prospectively disqualifying if, in fact, the recipient of a program-related investment does make a lot of money. But the intent of the foundation, in the first instance, is not to maximize profits, but rather to drive social change. And the program-related investment cannot be used to support or oppose a political candidate or party. And again, the reason is the same as would apply for a 501c3 organization. That is, we're using tax-subsidized money, so we ought not afford a given candidate or party a competitive advantage using public money. Lots of different ways to structure a program-related investments. And if you have a nonprofit that's going to be setting deposits in community development banks, even structure them as leases so long as they're at favorable terms to the recipient entity. and they can be equity investments. Now, as soon as I say they can be equity investments, I move because nonprofits have no equity to sell. They're owned by no one. They float for the public good. But when we say equity investments, we're now opening the door to have a for-profit entity, either attached to a nonprofit or freestanding, that is eligible to receive program-related investments. And that's part of the opportunity I want to share with you. So this is a laundry list of some of the program-related investments in which my firm has had a hand. You have a question, ma'am?
Can you cite some examples to make this a little?
I'm going to do that right this minute. Sorry it took me so long. These, in fact, are examples. These are examples of business activities performed by nonprofits or for-profits that were funded by program-related investments in whole or in part. Are you able to read that okay? I'm not sure how visible that is, especially toward the back of the room. But in each case, you'll see two characteristics, and they become criteria for recipients of program-related investments. On the right-hand side of each of these items, you'll see a purpose that feels charitable. It's educational, it's community development, it's agricultural, it's environmental. All those things would qualify as 501c3 purposes, and therefore qualify to receive PRI funding. And on the left side, we're talking about the kind of investment that was made. So the two characteristics that apply to each of these is, one, they're business. They're not program, they're business. They're revenue-generating activities to be performed by a nonprofit or a for-profit social purpose business. And the other is, in each case, there's an investment being made. Now, you couldn't make an investment in a program that is not itself generating earned revenue. But since we're dealing in social enterprise worlds, by definition, we have social and enterprise. Enterprise means it's a business. It's revenue producing. And social means it's one of these kinds of purposes. And just to flesh this out, this is more of the same. These are other nonprofit, for-profit ventures that have a charitable or similar purpose, in which I've had hands, that have been funded in whole or in part by program-related investments. And in some cases, I've represented the foundation that made the investment, and in other cases, I represented the nonprofit or for-profit venture that received the program-related investments. So does that give you a flavor of the sorts of, no? Why don't you flesh out your question so I can address it more directly?
So, like, for example, I'm acquainted with a university that had excess capacity of space, and so they invited other organizations in to use that space. Those organizations paid a fee for using that space. They were threatened that they lose their tax exempt status. I'm acquainted with a nonprofit organization that housed religious people, and they were dwindling as a religious organization, and they had excess dormitory space, so they would allow people to come in for private retreats or whatever. They were threatened that you're doing a hotel.
I understand your question.
501c3. That's what I'm trying to
I understand your question. Your question relates to what's called unrelated business taxable income. Each of these businesses furthers the exempt purpose of the nonprofit. And for that reason, number one, it's permitted without jeopardizing tax exemption. Number two, the earnings they realize are tax-free to the 501c3. What you're describing is you take a business opportunity that a nonprofit has, and it pursues that business opportunity, although under technical tax rules, the business activity does not itself further the exempt purpose of the charity. And in that case, it's competing with business community in an impermissible way and is taxed just the way business would be taxed. So it's really a case of in a very granular fashion, drilling down and understanding whether the proposed business activity could have directly been performed by the nonprofit without jeopardizing tax exemption, because it is an activity that drives the charitable purpose of for which the organization was awarded tax exempt status in the first place. So that's a threshold question. All of these happen to be performed by nonprofits, directly or through subsidiaries, where these activities were specifically contemplated by their applications for exemption from tax when working with the Internal Revenue Service. But you have a very good question, and it's called UBTI, Unrelated Business Taxable Income, which you want to stay away from, because in the first instance, if you have some of it, it's taxable. If you have too much of it, you can jeopardize your tax exemption, because now it's the tail wagging the dog, where the business purpose is really overriding what the charity was intended to be doing in the first place. So thank you for that question. Okay, so now this brings me to the L3C, the Low Profit Limited Liability Company, which is intended, among other things, to facilitate program-related investments for subsidiaries of nonprofits that are becoming self-sufficient, increasingly self-sufficient through earned revenue, or L3Cs that are freestanding social purpose businesses. Roughly half of the L3Cs in the country are tied to nonprofits. The other half are freestanding, independent businesses that have a social purpose and meet the requirements of program-related investments. So where we start here is with the limited liability company. How many are familiar with an LLC? Again, virtually everybody. Good, thank you. So the LLC is the most popular for-profit business form in the United States for privately held companies. Very good reason for that. One, the ventures liabilities do not flow through to the owner. So it's a shield against liability for entrepreneurs. Two, it affords them tax treatment that's flexible. Either the LLC, here we're talking about LLC, its tax attributes flow through to the owners on their personal returns. So early in the venture's life, artificial accounting losses and startup costs are deducted against income that the entrepreneur may realize from other sources. Later, it may elect to be taxed as a corporation in its own right, and the LLC accommodates that selection. And it has a flexible governance structure where it can either be a participatory democracy, that is, the members or owners make decisions by majority vote, or it can be a hierarchical governance structure where the manager or board makes decisions on behalf of the entity. And the LLC has all those features, all of them very attractive and for good reason are found to be beneficial to lots of businesses in the U.S. Well, the L3C is a subset of LLC. Everything I just described applies to the L3C also. And when I drafted the law, I purposely wanted to use a predicate that was well understood, where attorneys could, with great confidence, counsel clients about the obligations of managers and the rights of members. And here we have a 30-year history throughout the United States of how LLCs operate, and lots of case law supporting that. So that gives us confidence in giving advice and structuring transactions for L3Cs, which are a subset of LLCs. But the L3C has an overlay statutorily of other features and attributes that do not apply to LLCs broadly. And they are, first, it must be organized primarily or significantly, depending upon which statute you use, charitable or educational, in many cases both. It would have been formed except for that purpose. No significant purpose to produce income or encourage the appreciation of assets. No support of political candidates or parties. You'll notice these are exactly the requirements, point by point, for program-related investments. So it built into the law under which L3Cs are organized the very requirements that foundations will have in order to fund them. So let me give you an example. I'm going to stop there for just a moment to see if there are questions, because I feel as though I've thrown a lot out there. Yes, ma'am.
I'm curious to ask, in order to qualify for the PRI, does it have to be LLC or can you be an S corp through a corporation?
Yeah. And any entity, nonprofit or for-profit, can receive a program-related investment. The difference here is, among other features that we'll talk about, the L3C is the only form in the United States that specifically facilitates program-related investments because it, by law, it has these specific requirements. So as a foundation evaluates a specific target, they want to make sure that you check all the boxes. All the boxes are checked by law as to an L3C. Doesn't mean the money falls from the sky, it doesn't, it never does. But it does say that the requirements of a foundation that wishes to make a PRI can do so with this entity without fear that you don't meet those technical requirements. So this is now a hypothetical example of the capital structure of an L3C. It's no L3C in particular. In fact, it's made up, it's hypothetical. But I wanted to kind of show how it could work in practice. They're all sui generis. Each of them is designed unique to the facts and circumstances and the financial and social objectives of the participants. But we have the social returns along the horizontal axis and the financial returns along the vertical axis. And in this example, the first tranche or layer of the capital structure is the foundation, coming in, doing the heavy lifting. And here's pre-revenue. And my assumption here that the foundation is bearing the highest risk, for the reason I just described. But remember, its alternative would have been to write a check for a grant, and that money's never coming back. Here, with any return on investment contemplated, you have both return of investment and return on investment, neither of which attaches to a grant. But they're doing this primarily because of social returns rather than financial returns. And in my example, they're going to get 1% return here. It's just made up, intended to show very low return.
Question, Mark?
Yes, Valerie.
What would you prefer that rate to be in?
Why don't we just through this piece of it, and then I'll field your question if I haven't answered it. So the second tranche, I'm calling it mezzanine investor. These titles are arbitrary as well. And this typically would be socially conscious individual investors seeking blended returns. They're mostly concerned about mission. They want to support the mission of the organization. But they also want to get some financial return. Need not be risk-adjusted market rate returns. So here in this example, I'm assuming they bargained for 3% return. But they're doing it so they have social and financial objectives. And then, through the passage of time, the venture having been de-risked by virtue of earlier investors coming in, also having been de-risked because now the company's in business, you can move this all the way up to institutional investors. We have a number of L3Cs that have financial first investors of various stripes. And here in this example, we have a market-driven investor that bargained for market rate returns based upon the place in the life cycle of the business where those returns should be calculated. In this example, it's 6%. So in this example, this assumes a 4% total return on investments to these investors. None of us in this room would invest in a startup with the hope of getting 4%. It would not appeal to any of us. But here, we have different investors with different objectives, financial, social, even fiduciary obligations. Each is seeking the benefit of his bargain, and those bargains are different. So we're able to harmonize those different value propositions such that each gets what it wants. The foundations give up, essentially subsidizes returns to other investors who come in concurrently and subsequently. So that's kind of how that works. So Valerie, I'll take your question if I haven't fielded it.
Okay, yeah, I'm just curious as to how organizations
do they give away the social return?
How do they demonstrate? You know, the financial part is pretty straightforward, but how do you demonstrate the social return?
As one would do with any impact organization, I'm a believer in measurable social impact, and the metrics are created early on. The metrics can be contractual. Different tranches have different value propositions, different requirements. But what I find is, in a startup situation, resources are so limited that you can't have terribly sophisticated impact measurements. But you start. You measure activities. Activities are not a proxy for social impact. But over time, you find methodologies to ensure that what you're doing actually is working. And you need to know that not only to satisfy investors or other counterparties, but management, because you want to know what's working. That which is working, you want to double down on and scale up. That which isn't working, you want to either tweak and retest or abandon, because you'll always have limited resources, and you want to deploy those resources in the way that's going to be most impactful socially. But that's a different conversation, other than say to you, yes, we build it in and we need to build it in. Without that, we don't have anything. Okay, so the L3C's promise as a capital formation platform is it promotes financial self-sufficiency, continuing foundation support. Often the foundation will serve as a social venture capitalist. Well, they'll bring in not only money, but expertise, relationships, infrastructure. They're obviously a stakeholder now. Effective leveraging, we saw how that worked in this example. Capital flow to a double bottom line. Often we'll see triple bottom line, where they're both social returns and environmental returns. And it's a win-win for both for-profits and non-profits. And we're seeing lots of these that have different kinds of players. We have universities involved. We have government units involved. They all can have their own tranche with different objectives and playing in different roles, which is all harmonized, galvanized around mission. So that's the capital formation piece of the L3C. And then, even more important, some will argue, and some foundations are only investing in L3Cs because of their governance attributes, which are unique. And it has to do initially with silo bridging. You have different kinds of players without the galvanizing force of the statutes, where everybody understands mission always will be the North Star. You can have different people with different agendas, overt or hidden, and they will be dissatisfied and the venture will suffer. But here we have the ability to kind of bring everybody together around what I have called a clear and unambiguous ordering of statutorily imposed fiduciary priorities, which is another way of saying that mission takes precedence over everything else. And obviously, when I say that, implicit with what I'm saying is it's got to be sustainable, though. It's not sustainable, there's no business. But as you start fighting competing interests, mission needs to be understood as the driver for everybody, or those prospective investors who don't sign on to that will excuse themselves. They won't invest because of the way the thing gets structured. So you have a self-selection process where stakeholders, investors, and others will understand and commit to a venture that is to be mission-driven for all times. Priorities that can't be waived or negotiated away. Charitable tax-exempt purpose above all other, and profit motive subordinated to charitable purpose. Understand, if you had a traditional LLC, it's governed by an operating agreement. The operating agreement can be disregarded, waived, forgotten about, negotiated away. Here, we have an overarching statute, so it's not within the hands of managers and members, it's the statute. And this affords the organization, the best of them, and I'm seeing this now nationally, to have large-scale social change that requires broad cross-sector coordination, the notion being collective impact. And I've cited a seminal article that appeared in the Stanford Social Innovation Review, looking at the way in which the L3C can bring together parties in a way that drives social change without these specific features, which are generally unique to the L3C, might not do as effectively. So who's a candidate? Must have a charitable or educational mission, that's by statute. Must have consistent cash flow. Doesn't mean it needs to have large cash flow. It needs to have sufficient cash flow to pay operating expenses and meet obligations to third parties, including investors. And it is going to be entrepreneurial. That's the nature of the beast. Although we are finding more and more nonprofits that have either had programs that they wish to elevate to businesses, rolling those out into L3Cs, or pre-existing entities, pre-existing businesses owned and operated directly by the nonprofit without an intervening entity. For asset protection reasons and other reasons, I would discourage that. And they're finding, hey, let's move that out into a new entity. But by and large, these are entrepreneurial early stage ventures. So, any questions, comments? If not, I've very much enjoyed our time together this afternoon. Thanks so much for being here. I think there is a question. Please, yes.
How intensive is the application process to do the?
I'm sorry. Could you say a little louder?
How intensive is the application process to do the?
Yeah. Well, let's say it's the same as an LLC, which means you're filing articles with the state, and you are developing an operating agreement, which memorializes the rights and obligations among members and between members and managers. Any LLC has that, as long as there's more than one owner. And you would, as in the case of any LLC, you register with the IRS, the Illinois Department of Revenue. There's one additional feature. The operating agreement will look a little different, but it's the same document with some additional features. Under Illinois law, the L3Cs are subject to the Charitable Trust Act. I did that intentionally. Not all state laws have that. So it is, you register with the Attorney General and report annually to the Attorney General. It is not onerous, but it does give comfort to funders and other third parties who don't know about PRIs and don't know about L3Cs to be able to say, we're regulated the same as a charity is. And it does bring down defenses, and it's a legitimate thing to say because it's factual. But it's not particularly difficult. The structure, so long as the parties are kind of all aligned as to what they want to accomplish. Often when creating a business of any sort, if you have multiple players, the time is really in negotiating their rights and their obligations among them in a way that's satisfactory. We do have often more complexity in the operating agreement because if we have foundations and individual investors and we do crowdfunding, we have lots of different ways in which that might impact the complexity of the operating agreement, but it's still an operating agreement as you have in any LLC. So again, thank you. Yes, ma'am.
Why is it called an adult 3C?
Yeah, I didn't name it, but I'll explain the genesis of the name. I wrote the law, and as happens sometimes, others intervene. The point of this originally, and still, is to fill a market gap. The idea is that if you have a venture that has the expectation of modest financial returns, but the hope of significant social impact, you might not be able to get private sector investors that bear the financial risk because the rewards may not be commensurate with the risk. So the low profit was intended to reflect that market gap and how the L3C fills the gap by enticing foundation capital as a catalyst to other forms of capital. But again, there's no prohibition against making lots of money. We represent many L3Cs that are making lots of money, and they are reinvesting in the growth of their ventures, as well as making distributions to their owners. But thank you, very good question. Okay, again?
I think like one final thing that would be important to note is it was asked regarding, the process. Do you advise that an attorney be representing the organization, or is it relatively easy to do the paperwork?
Commissioner, and I knew there was a reason that I like you so much. Yeah, you need a lawyer who knows how to do this. It's a specialized field of law, social impact law. So, yeah, and although I would not necessarily recommend that a multi-stakeholder LLC be put together without legal counsel either. But yeah, there are certain requirements and criteria and magic language and obligations that have to be built into the documentation. Thank you very much for that. Okay, yes, Valerie,
Comment, not a question.
please.
I'm just amazed at your creativity. I never would have thought that you could use an L3C for the collective impact model.
Well, I will go home and tell my wife that Valerie Leonard is amazed at my creativity. Thank you for
Oh, you
that.
better not.
I'll keep our secret. Okay, thanks everybody. Pleasure to be with you all.
So, I think, we're gonna close out if there's no any other questions. I do want to, just, reiterate, this is like the first one that we are doing. I know that, Marc and, others have been able to do capacity building workshops through the Cook County Commission on Social Innovation before, so we are hoping to expand, into some of the other suburbs. So I do want to, just encourage you, if you know someone that couldn't make it today, we can keep you updated. Just make sure that you signed in, so we can, keep you updated. And if you do put your email address there, we can also send you some of the presentations and the contact information. Yes, Valerie?
Okay, where might we find the live stream?
It's going to be on the Cook County Commission on Social Innovation Facebook page, so it will be there. And if there were any other questions that maybe were not addressed, or maybe you go home and you think of them, if you want to reach out to our office, we'll be more than happy to make sure to filter those questions and get them to the correct individuals. So once again, I want to thank, of course, Valerie and Leonard for presenting today, and also Vice Chair Marc Lane, who's a great partner in crime on the County Social Innovation Commission. He's always great with presenters and is able to kind of help us with the efforts at the county. So thank you all, and of course, Franklin Park for having us here. Thank you, everyone.